Welcome to the Commercial Real Estate Show, your source for insightful analysis and enlightening discussions. I'm Michael Bull, your host to the world of commercial real estate. Remember, if you're listening to the show on one of our stations around the country, you may not always be able to get to the show on that station at the time you'd like to, so make note of our website. It's commercialrealestateshow.com or creshow.com. You can catch the shows of interest at any time you like. Well, today our topic is the restaurant industry. Please welcome my first guest, Daren Tristano, Executive Vice President, Technomic Food Industry, Facts, Insights, and Consulting. Daren, thanks for joining us today.
And thanks for having me.
Well, we appreciate it, and you guys do a great job of analyzing the restaurant and food industry around the country, and I guess around the world or North America. You tell us where you do your analysis, but how are restaurants in the U.S. performing overall right now?
Well, right now, restaurants are performing better is the answer. If you think about the first 3 months of the year, especially in the northern part of the U.S. where the climate was very cold from the polar vortex, we saw so much less traffic to restaurants and spending. So recovering from the first part of the year, we've seen it start to improve and spending starting to increase. Higher consumer confidence. Ultimately, the stock market has performed and the real estate market is starting to flatten and even inch up a little bit. So overall, consumers are feeling better. Their appetites and pent-up demand for restaurants has improved, and we're seeing slow, steady growth from the end of the first quarter into the remainder of the year. Now, with that said, there are also additional costs and higher commodity costs, which are driving up inflation, driving up the costs, and ultimately we're expecting a very, very flat performance for the industry, which means for those restaurants who are doing better, other restaurants are doing worse, losing that share.
Okay, and there's a certain part of the restaurant industry that's doing better than others. Is it the white tablecloth restaurants doing well? What do you see?
Well, on an overall basis, the restaurants that serve affluent consumers, the middle, upper, and upper class consumer who has more money to spend and is more insulated from some of the other economic conditions like higher gas prices, are doing better. And that tends to be the fine dining and what we call polished casual. These would be restaurants in full service that do check averages from $20 up north of $100. The other part of the industry, which is limited service, includes both fast food and what we call fast casual. Fast casual would be Chipotle, Panda Express, Panera Bread. These are brands that typically the check averages $8 to $9 up to around $12. Now, the consumers who are able to spend that money and consumers who stretch to spend that money are certainly doing so, and that affluent consumer is driving success for those groups. The other part of the world, the middle class and the lower income groups, are struggling to make ends meet and getting out to the Applebee's and Chili's and TGI Fridays of the world. And even McDonald's has been struggling with very little growth over the past few years. So we see that the more affluent, focused concepts are doing better, and the fast food, family-friendly, and casual dining are struggling because their customer doesn't have the money to spend.
That's interesting. We're talking with Daren Tristano with Technomic Food Industry. And so, Daren, what do you expect moving forward? You said that we've got some rising food costs. We have some other rising costs for these operators. So what do you expect, say, the rest of this year and into next year?
Well, I would expect for this year, a lot of these operators are sensitive to taking prices up for fear that consumers may not come out to eat as often. So they're going to bear the cost. And into next year, we expect inflation to return to about a 2.1, 2.2% rate, which is pretty standard. So trying to weather the storm this year, no pun intended, ultimately getting back to normal next year, seeing some growth in 2015, but likely very modest growth on a real basis, adjusted for inflation, likely about 1%, which is not a lot for an industry that wants to to really grow from a struggle over the course of the recession and the years that followed.
So that's bottom line growth, right, that you're talking about, not just sales?
It's typically sales growth, but
Okay.
its sales growth is around 3.5%, and inflation is 2.5%. That real growth is just the difference. It's what really changed when you take away the inflationary adjustment, and that's really not a lot of growth in an industry that was seeing 5, 6, 7% nominal growth years ago.
Okay. And who are the restaurant chains out there that are really most aggressively expanding right now, Daren?
Well, I think you have to look at the size of some of these restaurants. And to start with, I think you look at Chick-fil-A. Chick-fil-A is a brand coming out of the Southeast. They've moved into California. They've come into the North. They're expanding very rapidly. They're adding restaurants that do about $3.2 million per store. So they're expanding not only with units, but also with their total sales. And most of the growth with major brands are in the limited service space, because we have so many full-service restaurants, and the demand is still for fast food and fast casual. A second one would be Dickey's Barbecue. That one's coming from the South. They've expanded with fast casual. They do quite a bit of off-premise sales through catering, and they have been the fastest-growing chain. Beyond that, we're seeing sandwich shops, where we saw Subway growing to a very large platform of over 26,000 stores. We're starting to see the emergence of the better sandwich segment, which includes Firehouse Subs, Jersey Mike's, and those are gaining momentum, growing into a number of places. Jimmy John's has held that position for a while. They also incorporated freaky fast delivery, but this better sandwich concept is growing. And then beyond that, we're seeing really in the chicken category, along with Chick-fil-A, brands like Raising Cane's, which does fresh, never frozen chicken tenders, and another brand very similar, PDQ, down in Florida, that just added their 30th restaurant. They're focusing on higher quality chicken. So Popeyes, KFC, Church's are struggling with a concept that has unhealthy, crispy food or fried food. And all of these other higher quality concepts are growing. And then lastly, I think if we're looking at full service, anything that has to do with craft beer seems to be doing well. A brand like Yard House that has 150 different types of beer seems to be growing with millennials who like craft beer and are looking for a place they can go, a good occasion to socialize, and a good quality beer they're willing to spend more money for.
Well, thank goodness for that one. I like that. And what about real estate occupancy cost? I mean, real estate, went through the downturn. It's like you said, it's improving now. What do you see as you look at the numbers for the trends for occupancy costs for these restaurants?
Well, you would look at this market and say that so many restaurants are struggling or closing that it would be more of a renter's market. But the reality is it's more of a landlord market, because there is such a demand for high-quality A locations. The landlords have a lot of people who are competing to get these spaces. As brands grow and expand, they're trying to find these A locations, and it's driving rents up. I can tell you here in Chicago, total rents are between $40 and $50 a square foot, which is very high, especially for the U.S. Scottsdale, they're very high. I think what's important there is to recognize that even though the market isn't trending well, the need for good quality real estate is high, and as a result, we're going to continue to see high rents for years to come.
Okay. And is that percentage, occupancy cost percentage of revenue, so do you see that number increasing?
Well, I think what we typically have been seeing is stick to about 8% of total sales projections. And as I said, we're seeing closer to 10 to 11% in some of the markets, so it's becoming very difficult to find that space. So I think if you're going to be able to pay a couple of extra percent for occupancy, you have to find that somewhere else, and that's what's becoming difficult. When we know that the typical margins for restaurant operators are around 5%, 2% additional occupancy costs can really hurt you and make it difficult to be successful.
Yeah, that's a good point. If you've got a low margin, a slight increase like that can be detrimental. Well, Daren, thanks for joining us today. We sure appreciate your insight.
Thank you very much.
And if you like more from Daren, visit their website. There's a lot of great information there that obviously you can buy, but also there's some great information you can get there for free. The site is called Technomic.com. That's Technomic. Well, stay tuned. We'll have more on the restaurant industry. I'm Michael Bull. This is the Commercial Real Estate Show. We'll be right back. The Commercial Real Estate Show is brought to you by Bull Realty Commercial Brokerage, a great place to do business. Visit bullrealty.com. RealNex, a comprehensive suite of powerful commercial real estate tools at an incredibly low price. Visit realnex.com. That's RealNex. Sozo Web Hosting and Cloud Solutions. Secure, reliable, and worry-free. Visit sozo.com. That's SOZO.com. FIU, Florida International University. Earn your master's in real estate online in as little as 10 months. Visit FIUonline.com. And by France Media, providing exposure to the world of commercial real estate. Visit francemediainc.com. For more information on these great companies or for additional podcasts, videos, or blogs, visit creshow.com.